प्रेजेंटेड बाय ईबिक्स कैश, हर खुशी के लिए काफी है।
Hello and welcome to this market special. I'm Udayan Mukherjee. With me is Abha Bakaya, and our guest today on the show is a veteran of the markets. Earlier, he built a very credible fund management business and ran the operations there, investments there at Reliance Capital, and now has his own firm for the last few years. He's the founder and CIO of Abacus Investment Management. Sunil Singhania joins us on the show today. Sunil, good to see you after a long time, but it's an interesting juncture to be speaking to you because after a long time, the markets are correcting and correcting quite sharply. Is it the Paytm factor? Is it the Reliance factor? Is it the repeal of the farm laws? What do you think is worrying the market or leading or triggering this correction?
So, thanks for having me, Udayan. And it's always easy in hindsight to, pinpoint the reasons for what has happened. But I think last couple of months, money making was becoming too easy, frankly. And all these IPOs opening at like 100%, 200% premium and getting subscribed 500 times, 1,000 times was getting a little bit unreal. And frankly, despite the fact that some of these have created businesses like out of nowhere and we adore them, I think the valuations were a question mark. At least, conservative investors like us hardly understood it. So I would say it's a combination of a lot of things. The market needed some reason for it to correct. And maybe the Paytm reason was a bigger reason, and all others just added to it. So I would say that it's been a sort of a welcome correction. Obviously, no investor likes a correction, but the fact of the matter is, what we are down like 5-6% from the top. So it's hardly a meaningful kind of a correction. And from here on, it's always good that you cool down a little bit, you get your bearings in place, again figure out things which might not be the best things to do in as far as investing is concerned, and then move ahead.
And what's an old-fashioned investor like doing in approaching these new digital listings? They've all corrected after the Paytm episode. Are you looking at them closely, or do you think they still have not arrived at valuations which would tempt a traditional investor like you?
So again, first of all, it's not necessary that if you're a traditional investor, you don't like growth. Frankly, we have been very successful, and so have been the other investors in buying growth stocks. But, there is always a value you put to it. So I think the one thing which we always remember is that what you pay today to buy a stock has to be more than repaid by way of future profitability. I think that is one condition which is sort of, non-negotiable. As far as some of these recent IPOs are concerned, clearly, as I said earlier, we adore them. They're entrepreneurs who have created new businesses, have brought in a lot of FDI for India, and have also created, hundreds and thousands of jobs. And, salute to them. At the same time, the fundamental aspect of valuing them has been something which at least we as investors have not understood. So as I said earlier, there has to be some sense of future profitability coming in. So either you are building a business to make profit, or you're building a business to just list or sell out. And, obviously the second seems to be more the thought process here. And that is the reason, at least we have avoided this hype kind of new age businesses. There are some businesses which will do very well, even in the new age businesses. Some businesses we like. There will always be difference of opinion as far as valuations are concerned. But quite a few of them have got listed just based on the perspective that they might go up in stock prices, not necessarily make profits.
Now, you said correctly that it's only a 5-7% correction after such a big run. And the run has been stupendous in the market, given where valuations are. Even allowing for the fact that a new earnings cycle might be beginning, would you expect this correction to deepen? Because even strong bull markets take in at least 10%, sometimes even 20% running corrections. What do you think this one could be like?
So you're right, Udayan, for us to go to 10% is another 3-4%. And I would say that would be our sort of a guess that maybe, 3-4% left as far as the markets are concerned. Actually, if you go in the broader markets, stocks have corrected anywhere between 10 to even 25%. So the correction is not very visible from the headline Nifty. Actually, if you go deep down, stocks have actually corrected 10 to 25%, and that's not a very pleasant thing to see if you have stocks which have corrected so sharply in your portfolio. Our view is that there are a confluence of factors on the positive side. Obviously, as you rightly said, earnings growth looks phenomenal. Next 2 years, FY22 and FY23 put together would see a 50% increase in profit compared to FY21. Valuations are not cheap, but they are not exorbitantly expensive. I think come January, February 2022, we will all start to talk about financial year 24. And on that basis, we are like at 18 and a half times. And it's 15% higher than the long-term trend, but it's not like completely out of whack. And then given the fact that at least our view is that liquidity is going to continue, and you also have a confluence of both private capex as well as the government capex coming in, I think we're getting into a good situation where GDP growth can surprise on the upside for the next 2-3 years. What we also have to not forget is that traditionally, the November to February, March period is a good period as far as rebalancing of FI, allocations are concerned. And at least, my interaction with friends overseas point that India might be gaining in terms of allocations at the expense of maybe China in this round. And therefore, on this correction, our view is that smart, institutional inflows should start to come in. We are also heading into a phenomena or a phase where government is on an overdrive in terms of privatization, in terms of getting the economy back on track. We have the union budget coming in January, and traditionally there also is a rally preceding the budget. So I think both on the fundamental and technical factors, our view would be that max maybe another 3-4% to go, and then we should start to see some semblance of stability coming in.
I want to talk about Paytm in particular and your view of what's transpired, the weak listing, whether or not it's a trigger in a sense for the markets. There has been a lot of uneasiness with regards to the kind of valuations we've seen. And while, of course, Vijay Shekhar very emphatically in his interview with Udayan talked about a sound business model and a clear path for growth, it's potentially going to take quite a while before they match up to the kind of valuations they're trading at.
I don't want to stock specific, but I can only add one thing here that again, I think Paytm is a great startup which has been built painstakingly over the last few years. Even I use it, at least as far as payments are concerned. As far as investments is concerned, obviously, it's upon the investors who have invested, to answer that question. I think what has happened, maybe, what typically happens, Abha, is that if an IPO opens at a discount to the offer price, there are a lot of flippers or, investors who just invested to flip and make some listing gains. They get a little bit nervous and they just want to close out their position. So it just adds to the softness. And obviously, the fact that the markets have been soft over the last 2-3 days in particular has not helped matters. So it's been a confluence of factors. I think it will take some time, maybe, to stabilize. There have been instances where companies have listed at a discount and have come back if the fundamentals start to keep pace. But let's see how it pans out.
The other space which is showing signs of a correction is the commodity space, Sunil, because their stocks had gone up significantly, but of late there has been some kind of concern about whether the cycle is peaking, the news coming in from China, and whether these stocks are now trading at peak cycle valuations. So how do you approach this commodity, specifically the metals basket, in the light of the correction?
So they have had a dream run, post the lows made in during the COVID times in mid-2020. We have seen commodities, really do very well. I think one thing which has helped them over the last 12-18 months of record profit is their balance sheets have been, completely restructured for the better. Debt has come down. So, for example, if you take the steel sector, they used to make 50,000 crores of EBITDA and they had 3 lakh crores of debt. So technically, they had like 6 times debt to EBITDA, which has come down to 1:1 because, EBITDA has gone up to 1,50,000 crores and debt has come down to 1,50,000 crores. And that makes them very stable. obviously being deep cyclical, and the fact that China is anywhere between 50 to 60% in terms of consumption for all these commodities, the China factor plays a big role. And last couple of months, China has clamped down on construction, on their new residential construction activities, and so on and so forth, and also clamped down on iron ore and coal and so on and so forth. And therefore, we have seen some reaction as far as metal prices globally are concerned, but we remain quite optimistic on that space. If you actually see prices ex-China for across commodities, prices have corrected by 5-7%, but not significant, as has been the case in China. And even now, prices on an average for this quarter would be higher than the July to September quarter. Yes, there might be some cost impact also because, coking coal prices and coal prices have also moved up. But I think overall, this correction would be a good opportunity for investors to relook at it. Having said that, I think a few things. One is these are deep cyclicals, and therefore an investor cannot have like 30-40% of their investments in these cyclicals. We, by rule, have maximum 5 to 8% in these deep cyclical companies. The other thing is, we are going to, on the positive side, going to get into a very busy season. We are past monsoon. Construction activity will pick up. As I said earlier, both government capex and private capex is looking like picking up. There's a huge money supply, and there is propensity for everyone to look at capacity expansion. So, given all this, we are quite constructive from a couple of years perspective on the entire metal.
The other cyclical space, Sunil, which has perked up considerably after 7-8 years is real estate. The stocks have almost in every case doubled, some have even trebled. What is your sense of this revival in real estate? And as an investor, is the right way to buy real estate stocks now or to buy some of these home building materials, some of which I see in your portfolio today?
No, then again, this is one sector which benefits a lot, because of lower interest rates. It's to some extent, globally, real estate is considered to be a financial sector in the broad basket. And I think there's lower mortgage rates of 6.5, 6.6%. And the fact that for 5 years, we have not seen any increase in residential house prices. And also the fact that unlike the expectations of a salary cut and job losses, we have the reverse. We have seen salary increases, particularly in the IT side. There has been hardly any job losses. And therefore, there is now this huge attractiveness of buying houses. EMIs are down 20-25% because of lower mortgage rates. And therefore, residential housing as a segment is seeing huge uptick. And our view is that should continue. Having said that, we have a very, I would say, strict return on equity criteria. And therefore, instead of buying developers, we are preferring going through either the housing finance company route or the building material route. But our view is that we are here to see good traction as far as residential house demand is concerned from a 3-4 years perspective.
Sunil, what else is exciting you in terms of a longer-term horizon? We've seen IT companies outperform and continue to surprise on the upside. Is that a trend that you're continuing to capitalize on? Are you investing or looking at allocating more when it comes to that bucket in the market?
So, one is, we are lucky to be investing in India, and we've been eternal India bulls, and it's helped. Being positive on India has helped. And I think next 3-4 years, we again see a good sort of a cycle of growth led by lower interest rates. And obviously, generally, companies doing quite well. I would agree with you on the IT services / digital front. Digital as a segment is awesome. There is no doubt about it. Our own individual habits of using digital for everything we do is there for everyone to see. The only problem has been the valuations. And, if we get, an opportunity, maybe, this meltdown in some of the digital plays would allow us to invest in future IPOs of good digital companies, maybe at a decent valuation. That would be a great opportunity. Maybe some of the listed plays might give us a reaction and allow us to invest. I think digital as a theme cannot be ignored. IT services, again, there has been meaningful correction of almost 15-20% in a lot of companies, maybe a little bit more correction. I think IT services company, Indian IT services company are globally competitive. There is this huge move globally towards moving into digitization from all corporates. And I think we are already seeing demand, being very robust. Some of the other segments where we are quite positive are homegrown brands. We are seeing consumption coming back all over the country, particularly in tier 2, tier 3 towns and smaller cities. We are seeing a phase where after 2 years, entire country is opening up. We saw how during the festive season demand has shot up. In the next 6 months, I have heard that there are a record number of weddings. When we see our own circle, no one celebrated their anniversaries and birthdays and so on and so forth. They're all going to come back. So I think the next 6-8 months, discretionary consumption should do very well. At the same time, we have to remember that there are two pockets of discretionary consumption. One is the very obvious names which are trading at 80-90p. I think those are not something which we are looking at. But at the same time, there are, as I said, the second tier brands which are focused more on towns and smaller cities. I think that is where there is huge opportunity.
Some people invest directly in the stock market, Sunil, and some look at opportunities in the stock market related universe, in the universe of stocks. I mean, some look at, say, brokerages, others look at asset management companies which are listed, and some look at institutions around the stock market, like, say, the stock exchanges or even the CDSL, CAMS kind of plays. Of these three baskets, brokerage, stock market institution, and asset management companies, what would be your preferred way of playing a enduring revival in the stock market?
I think that's a great topic you brought up, Udayan. In fact, we are quite positive on the entire non-fund based financials, and I would include the insurance companies also here, which would be to some extent be like the wealth management / asset management companies. So we are very positive on the entire space. Obviously, exchanges and some of the other platforms you mentioned have monopolistic kind of business. They are irreplaceable. And there is a regulatory sort of protection because, you have to get approvals before you can have a competitive kind of a thing. Some of them have become a little expensive, but I think those are segments and companies which you just can't ignore. The asset management and wealth management companies would stack in also pretty good. The financialization of savings, we have seen how it has happened over the last few years. It is only going to get strengthened. And asset management as well as wealth management companies, and I run an asset management company, so I know we benefit from two ways. One is the appreciation on your existing AUM also gets you fees, and then there is an additional saving which all of us end up having every year, which also comes to you. So it's a great business where compounding can be 10-12% coming in from appreciation and 10-12% coming from fresh flows. I don't think there are too many businesses which can over a period or over a cycle grow at like 20-25% CAGR. Broking companies are also interesting. The only problem is it's a transaction based revenue. Unlike wealth and an asset management company, which is an annuity model, the brokerages would have a transaction based revenue, and therefore there will be more ups and downs depending on what stage or what state of the market you are in.
We spoke earlier about the revival in commodities as a cycle and the revival in real estate as well. Now, let me ask you about a capex revival, because after many years, there is a strong buzz on the ground that as demand recovers, we will finally have a capex cycle in India, and typically they last 3-4 years. If you believe that, what is the best way to play it? Is it to go after the L&Ts of the world, the construction companies, or is there a better way to play a likely capex revival?
So you're right. When we speak to companies, I think a lot of these companies are now, operating at like 80-85% capacity utilization. And normally it takes like 2 to 3 years for capacities to set up, whether it's cement, steel, even power, and so on and so forth. And last 5-6 years, because the environment was so benign, no one even thought about, or had the courage to set up capacities. And therefore, suddenly you are seeing this huge bunch up of capacities being planned by companies across sectors. There have been some headwinds. I think metal prices have shot up. So the capex outlay for a lot of companies have increased by 15-20%. And I think that is causing them to delay or, even think twice before embarking upon this capex. So the capex cycle is up there. It might just get delayed a little bit to some extent, but it is still there. Also, there is now this, I would say this, from an investor's perspective, the good capital equipment companies are not so cheap. So it is, we can all argue that we are in this 2003, 4 to 2008 kind of an environment. But there the environment had a tailwind, but the valuations were also very cheap. This time the environment might be having a tailwind, but the valuations are not that cheap. And therefore, some of the well-known, capital equipment companies are not that cheap. But I think you don't have too much of choice there. On the EPC side, I would say the survivors are the ones which have a better balance sheet. So unlike the past where we had like 50, 60, 70 EPC and construction companies and 70, 80% of them went belly up, this time you had like 6, 7 survivors, and where debt is in control and the return on equities are also pretty decent. But those companies and that segment, which is EPC and construction, always are looked at with an eye of caution as far as investors are concerned. We are pretty open to investing in them, but having burnt our fingers in the earlier phase, we try to restrict our exposure to the EPC/construction companies. Equipment companies, wherever we are getting an opportunity, we are up there, in investing. Our view is that there is huge operating leverage. Their gross profit margins are anywhere between 40 to 50%. If their top line grows, all the other expenses remain the same, and the EBITDA, the impact on EBITDA positively can be huge. So we would be more with the capital equipment plays, but we'll have to buy it a little expensive.
Sunil, always a pleasure talking to you. Thank you very much for taking time out today on an important day in the stock market. Thank you.
Thank you.
That's our market special for today. We shall return next Monday with another voice of experience from the market. Till then.